So we have a very interesting session which we are going to start with today. So far we've covered a lot of topics on transfer pricing. We've covered transfer pricing aspects of financing, of services, of intangibles, and we've also seen how to go about allocating profits to a permanent establishment. What are the core issues and key challenges with the help of case studies in all the sessions. This session is also extremely important because it deals with one of the most common intercompany transactions that you would see within a multinational group. That is with respect to commodities, at least at the raw material level. And then it also deals with the sale of goods among various associated enterprises. So the focus of this session is to deal with commodities and goods. And for that, we have a fantastic panel once again, highly experienced people coming from consulting, policy, from the policy-making institutions, as well as from multinationals. So we have a fantastic panel here right now today, and I would like to hand over the session to the panel chairs. So we are going to split this session in two parts. So there's going to be one part on direct taxation and one part on indirect taxation. The chair for the direct tax panel is Olivia, and the chair for the indirect tax panel is Fabio. And I would like to hand over the floor to Olivia and Fabio.
Thank you very much, and thank you for the invitation and organizing such an excellent event. It was already mentioned yesterday, but it's not a small task with so many people, I think, attending. And good morning to all the participants. It's great to be here. In this session, as Vikram said, we are going to discuss commodity trading. For those of us, at least me, enjoying a nice cup of coffee, I don't have to convince of the importance of commodities. This sector is perhaps less under the radar than it used to be, but it is not always well understood. Very easy for some, very complex for others, but either way, the large volume, low margin, high risk nature of commodity trading, together with its deep connections to economics and geopolitics, brings us interesting challenges for transfer pricing controversy management. I'm Olivia Gedge. I'm a director in KPMG's transfer pricing practice. I'm based in Geneva. I've been advising clients for the last 15 years internationally, and I also enjoy very much teaching on transfer pricing at the University of Lausanne, including on commodity trading. And I'm always fascinated about the statistics that I see in Switzerland. You know, it's one of the global trading hubs, and Swiss-based commodity trading companies handle around 50% or more of global trade of coffee, grain, metals, and sugar. I'm also very happy to be here with Cynthia Catalao. Cynthia is a tax professional with more than 15 years of experience in dealing with international tax matters, including transfer pricing setups, business support, and overall tax compliance and litigation. She has focused mainly on commodity tradings. She worked for a trading house in the last 7 years, and before that was in the mining industry and has significant experience there, and in particular in developing countries. So very happy to have Cynthia here, and she's going to share some great insights from her industry experience. And just briefly to let you know what we're going to cover in this first panel, first we will go through some recent court cases, second, current and future trends we see, and finally we will go through together with Cynthia in a Q&A format through some practical insights on how to manage basically this increased controversy. And with that, I will hand over to Cynthia to present the Gen court case, which we have on the next slide. If we could show that particular slide, Massimo, please. Thank you.
Thank you, Olivia, for the introduction. It's also my pleasure to be here today with all of you. As Olivia just mentioned, I've been dealing with tax matters for commodities for quite some time, more than 10 years now. It has been a very challenging and interesting experience to me. So I hope what we have to share today is also of interest to everybody who has joined this morning. Quickly, just as part of my presentation, I'm going to talk about the main transfer pricing aspects associated with the Glencore court case. And we'll also do a quick parallel with other similar cases involving commodities as well. Going directly to the Glencore case, the case addressed two main points. One was how far the tax authorities could go in terms of having flexibility to recast a commercial transaction or actual transaction to simulate what would be an arm's length price if the transaction were to be carried out between independent parties. And the second aspect that's also important to mention is the importance of having reliable comparables and evidence to support your intra-group pricing. Before we enter into the Glencore case itself, I think it's important to explain a bit quickly how commodities are generally priced. So the prices for commodities are based on international market prices that are usually quoted in recognized metal or exchange markets. For copper, which was the product traded by Glencore, the reference price, the market price, was the one quoted in the London Metal Exchange. The commercial contracts for copper concentrates are usually structured via offtake agreements that cover usually the production of a local mine, and they are a variation of this quoted international price. And the price is also defined based on what we call a quotational period, so a period of time where you're gonna apply your index of price for. Because in the case of copper, the copper that is extracted needs to be refined before it's sold, the price component usually accommodates as well a discount for the refining costs and other costs for treating the material before it's sold. So in most contracts, the market price will accommodate that particular discount with respect to copper, but also other discounts associated with the content of other metals in the product that you are trading, impurities, freight, and other costs. Particularly in the case of Glencore, the transaction was a very straightforward one. One of the Australian copper producing mines of Glencore was assessed on the transfer pricing aspects of the sales of the copper concentrates it was making to the parent company in Switzerland. They were adopting before 2007 a market price based on benchmarking. So it was a combination of historical benchmark and spot prices for copper concentrates. But in 2007, the group decided to change the pricing and they adopt a different pricing, which was what we call price sharing. So the local mine would be compensated based on the price of the copper concentrate as quoted in the LME, minus a discount that was fixed at 23% of that price, which was supposed to cover the refining costs, among other discounts. And what they also changed was the quotational period. I believe the previous contract, they had a fixed quotational period that would be reviewed on an annual basis. And after 2007, they changed it to bring optionality on the quotational period itself. So they could also have the option, if the buyer wanted, to backdate pricing. And the tax authorities assessed that change, that structure of pricing, because they said it was not within market and that it was somehow detrimental to the mine. So what the tax authorities did, they basically recasted the actual commercial transaction in order to come up with a hypothetical price, as if the transaction were between unrelated parties. The prevailing position of the court at the time was in favor of the taxpayer because of mainly two factors. One was that the flexibility for the tax authorities to recast a transaction cannot go without limits. The tax authorities need to respect the actual commercial contract. They cannot rebuild it in a way that the transaction will become completely different from the actual commercial transaction. The local court also made reference to the necessity of being aligned with the international OECD principles, because otherwise the application of the local rules will be very disconnected and will bring a lot of uncertainty to the taxpayers. The other aspect that was very important in that decision was the comparability. The company was able to properly support why they were pricing in 2007 as they were pricing, why there was a change. And they also provided as evidence comparable contracts, although they were not very similar to the transaction between the two related party entities. The court relied heavily on those comparables because the price structure agreed with third parties was similar to the pricing that was then adjusted and agreed between the related parties. The evidence of the market was also very strong in the case. And I think that's a very important factor to consider also for our regular transactions. Just quickly doing a comparison with other cases, this element of limiting the ability of the inspector to recharacterize the transaction was also mentioned in another court case in Canada involving a company called Cameco, where the judge also made a lot of reference to that. Last but not least, I think it's also important to mention another case related to in Zambia in this time that was actually against the taxpayer. But the important part that I think we should mention is that the taxpayer lost because the court also used heavily comparables, and they recasted the sales of the local entity to put the same price as they were selling to third parties. So they were selling to third parties domestically at a higher price, and then they were assessed, and they had the sales, the Intra Group sales recasted to that price as well. So Olivia, back to you. This is my take on the court cases. I think you are.
Thanks very much, Cynthia. I think that was a great summary of this case, and I look forward to discussing with you a bit in our Q&A some of the learnings again. I would just let you, Cynthia, run through the key trends that Massimo has kindly put up already on the slide for us, and then we can come on to the Q&A. So back to you, Cynthia.
Yeah. So in terms of trends, I've been hearing some rumors that we might have a new cycle for commodities in the next year. So what shall we expect? More assessments to come. We can discuss it a bit later in our Q&A. I think main takeaways from the court cases and a bit sharing of my experience. I've seen, especially in developing countries, that tax authorities have more access to information to support tax assessments. They also have proper tools now to capture transfer price information, usually connected to regular income tax compliance routine. We are going to talk about it later in the Q&A, but Brazil, for instance, just released day before yesterday new regulations with respect to that. TP discussions, we have to be very careful because TP discussions might come from non-TP audits, normal audits as we know, but also potentially P assessments, customs discussions, name it. And quickly just on Brazil, we would like to highlight a bit later how the transfer pricing rules work for commodities and discuss a bit the potential move of Brazil finally to OECD.
Yeah, and I think obviously as part of the new cycle, there's also the economic environment that we see at the moment, right? We've got the COVID crisis, which actually for the commodity trading has shown basically the importance, and quite a lot of traders have done rather well because they are used to managing such uncertainty. We've obviously also got a bit the general trend around sustainability. So there's a couple of possible trends we may see on the business level. One is the perhaps increased financial capacity, which would have some intra-group possibly ramifications. We heard yesterday from the panel, obviously on the financing, Perhaps something to bear in mind. And the other thing that we may see is perhaps a bit more M&A, either, you know, companies deciding to vertically integrate when they can, obviously with the extra, you know, financial capacity, or on the other side, divest perhaps on some specific, you know, circumstances. We are seeing companies, for example, divesting refineries, which typically in Europe at least are not are struggling. So with that, thanks so much, Cynthia. I think let's use this last part now to reflect together on the learnings from those cases and experience to see how we can prepare basically for the future. So with that, we've summarized on the next slide just the sorts of questions that we want to cover. So let's kick it off. Cynthia, you know, you've already shared with us the, you know, some very interesting cases. What are for you your main takeaways on these? Cynthia, you're on mute.
My main takeaways from those cases are with respect to flexibility for the tax authorities to recast the transaction. They don't have unlimited, let's say, powers to do so. They need to stick to the actual commercial transaction to do the hypothetical arm's length price. Another important takeaway, and going back a bit to my regular practice, is that as part of any tax discussion, you need to know your pricing, you need to know your market. I think the commodity industry seems very simple because it's extracting, maybe processing and selling, but there is a lot more to that. So it's important that this is explained and that when you enter into those discussions, you make it clear how your pricing is agreed and give an overview of your market. And also have documentation, group documentation to support your pricing strategy, and ideally comparables, even if they're not similar to your case, but comparables also played a big role in the court cases in favor of the taxpayers.
Yeah, I think those are great insights, Cynthia. I think it's also, I share the view that obviously tax authorities should not recreate their view of reality with a whole new transactions. I think in practice, though, that also means taxpayers have to pay special attention to actually, you know, to demonstrate that that commercial nature that you've described very well. The OECD guidelines, you know, I think is hinting at that, or more than hinting when they refer to the options realistically available. Now, obviously, if there are some similar, as you said, maybe not perfect reference transaction, then that's great because that helps to show that indeed third parties are doing it. But nevertheless, the OECD is also clear that just because something is not happening does not mean it's not arm's length. Mm-hmm. Just probably means that you're going to have to spend that extra effort to explain that commercial reality, and we'll cover that with some examples later on. So perhaps now, if we look at some of the trends that you've mentioned, taking some in order, you know, you first pointed to the, I think rightly, to the much easier access now that tax authorities have to support potential assessments. You know, what would be your recommendation there for us to prepare?
Yeah, I think as probably everybody knows, having access to information does not necessarily mean that you have a good understanding of your industry. I see more and more local tax authorities being educated on transfer pricing. So you should not expect that you're going to have a quick discussion with them or an easy job. They are getting more and more knowledge about, you know, international arm's length principles and how to apply them in practice. So don't underestimate when you enter into discussions, especially in developing countries. So in terms of trends, again, I believe have your group documentation ready. Be ready to have a good exchange with the tax authorities. Demystify a bit the commodity industry. As I mentioned before, I think it's very important that you be open and you try to explain in detail what you do locally and what is done outside the producing country, because they might underestimate what they cannot see. So it's really important that you explain that. So you have like as a starting point, a good play field to be able to entertain good discussions with the tax authorities. Also, in terms of documentation, just make sure, I don't think I need to say that, but make sure that you have what is required locally in terms of transfer pricing compliance, and that those documents are in line with the local rules.
Yeah, I think it's an excellent point you make about the understanding of the industry, because as you say, on the one hand, there's I think better information. Certainly when I came to Switzerland 7 years ago, commodity trading other than in Switzerland, I think was quite under the radar. Yeah. And then you could see in the press, and also there was a lot of campaigns, I think, by commodity trading themselves, traders themselves, when they realized that regulation may hit them to as you say, demystify this industry. Yeah. But nonetheless, it is extremely specific based on the commodity, and I think this is something that sometimes you know, perhaps us included advisors, we can underestimate. You know, the actual underlying commodity drives a lot of things. It drives, I would say, the structure and the pricing. So if we take those in turn, you know, on the structure, the specifics of the value chain, you know, what exactly is being done, as you said, is it production, is it transport, is it much more than that? But also crucial in this industry, the allocation of risk. So contract-wise, obviously, but also the practical management of that. Yeah. You know, it was referred to yesterday about competence. What are you actually doing to manage that risk? And this is very much the case for traders. But then it really is back to what is the commodity also? You know, is it liquid? How easy to transport is it? Can risks actually be hedged, right? We have some industries, like, for example, the mining companies can struggle to hedge. So in a third-party situation, maybe you would not have hedging going on. So again, now that you're in an Intra Group situation, are you going to be willing to have a party that cannot hedge and take on the risk, or would you rather have some kind of maybe limited structure? Another message we had a lot yesterday, or that I took away, was that you know, qualitative assessments and describing your value chain, you know, is very important. And to me, this is no different in this industry. At very minimum, we can help to put that basic framework down, even if it's, you know, some diagrams, explain why risks are the way they are in terms of allocation. And I think semantics can be important. So, you know, trading is used for many, many things. You know, you come in, you do your fact-finding interview, you imagine it's going to be trading in the sense of, I don't know, somebody taking a short or long-term strategy, and then you finally realize that we're talking of an integrated group where pretty much we have salespeople. So maybe the characterization is more of a distribution one, and that will really drive a lot of the transfer pricing analysis. And obviously also on the pricing, you know, some commodities like nickel are only really or mostly produced within groups and sold then within the group. So you will not get those third-party comparables. Setting that scene for your transfer price analysis and to guide your tax inspector, I think is really vital. The good news, I guess, from what you're saying, Cynthia, is that you know, commodity traders know their industry inside out. So you will always get you know, solid, I think, grounds for the transfer pricing analysis. And the other thing I would say on that is that, you know, in, for example, oil, it is more common to use perhaps the comparable uncontrolled price method, CUP. We see that used both for setting prices, but also sometimes in defense, and tax authorities like that because they can go and check the references. But there it becomes absolutely vital to have good contemporaneous documentation because, again, tax authorities will likely ask for that. And again, traders know very well what was the market circumstance, but when you're a busy trader where time is, you know, the essence, capturing that in documentation is an extra challenge. So I think practical tips are trying to establish good collaboration between, you know, in-house business, traders, tax. Everybody understands, you know, what we can do, what we can't, and then preparing your controversy management accordingly.
Yeah.
Okay, so moving on to the other trend you mentioned, which was investment in training and implementation of tools to actually capture more transfer pricing information as part of perhaps what seems to be routine tax, broader tax inquiry. What would be some takeaways there?
Yeah, no, that's completely right. I had a few cases, for example, in Zambia once. We were very close to the limit of the deadline to file our regular income tax return. And then we realized that they, as part of your filing, they were requesting extensive information on your transfer pricing and intra-group transactions. And we were not ready to comply with that. And there were risks involved because what do we provide transfer price information that's not the best because we were not ready? Do we delay filing the return and have the risk of have an assessment on a deemed margin and impossible to close as well? So I think my takeaway from here is that more and more the tax authorities are implementing tools, as we said, to monitor and get access to information, and they are linked to your regular compliance. So don't underestimate that. For instance, as I mentioned, Brazil recently just released new instructions asking for much more information on the transfer pricing calculation in detail, the market price you are using, dates, why you are using that index and not the other index, the adjustments you are doing to support them. So more and more you're going to be required to have information. And my experience has also been that everybody's busy working, right? Including the traders. So don't leave to prepare your group documentation and basic documentation to support your transfer pricing for the last minute, because people will not remember, it's going to be in a rush, and the quality of the information will be compromised. So, and the last point I think that is important to mention is please align with your headquarters, because I think worst thing is when the parties don't talk and the transaction seems a bit strange, So make sure that your headquarters, the tax team is involved. They can provide the information as well to the local teams. And the more importantly, it's going to be aligned. So you're going to walk the talk. So the documentation you're going to prepare will be aligned with the group policy, and chances are you're going to have less issues to close a case.
Yeah, I fully agree. And I think, as you say, that's really the goal. If really this is, I know that, sometimes there just isn't time to do everything. I think at minimum, having a plan, what will be managed proactively, what will be managed reactively, is the bare minimum. I think sometimes just having primary, documentation, like are the intra-group contracts in place? Have they been signed? Some basic, let's say more basic homework to make sure local teams have this ready by the time that this routine assessment comes. And as you said, I think it's a really good idea if have obviously some transfer pricing documentation, or then perhaps at least some short, maybe extracts that you agree as a group. You will always, have the same picture. Here's my group, here's my strategy, here's my value chain. And so you keep some consistent messages, and especially on that commercial reality you mentioned. So people avoid giving their own view and muddle a bit the picture. Mm-hmm. Okay, so you also made the point, I think, Cynthia, earlier, that a lot of you've seen a lot of transfer pricing assessments come out of perhaps what seemed to be a totally different, PE assessment.
Yeah.
Can you tell us a bit more about this experience that you mentioned?
Yes, I've had a few cases, mainly in Africa, that started as a taxable presence discussion, a PE assessment, because they know the market price of the commodity. It's easier for them to issue a PE assessment and deem a margin and assess you for income tax on that. But essentially, the discussion is not really only PE. The discussion is, at the end of the day, particularly for the profit that is going to be allocated locally, transfer pricing. So my message would basically be don't underestimate assessments that don't come with the label of a transfer pricing assessment or from a regular transfer pricing audit. So again, be ready to have your documentation. What is really helpful, as Olivia just mentioned, is short documentation explaining your business, your pricing, your market, and your value chain. This helps a lot. And if local teams will be dealing with the tax authorities can also explain that properly, I've seen cases that were very successful in my experience, because we were able to demonstrate how the market works, and the local teams were able to explain the industry and what was done locally, what was not done locally. And this is very helpful when dealing with the controversy and assessments.
Did you, in those assessments, did some of your business people also join, or did you avoid that there was a...
We usually avoid, because, you know, you never know what can come out of those discussions. But in some cases, we used finance people locally who knew a lot about the business, and they were able to explain properly the activities and the assets and the risks. And those were very successful cases as well.
Yeah, and I think we all, I mean, I think another thing that's super important and sometimes easily forgotten is to just always have in mind, you know, all the other taxes beyond, let's say, just transfer pricing when we're preparing our documentation. Yeah. I suspect that's going to be one of the messages in the next panel about, you know, indirect tax. Don't forget us. When you're doing, for example, your master file, we often have triggers of, I don't know, withholding tax in some of the developing countries, PE, but there's of course many other things. Perhaps let's just close off with Brazil. You know, that sounds like an important development you mentioned, not least the one that was yesterday, and also generally the hopefully potential change to the OECD. It's been on the radar for a while.
Yeah.
So, you know, can you just perhaps give us a brief overview of those rules and what you expect with this alignment when it comes to OECD?
Yeah. Well, raise your hand if you have not faced difficulties dealing with Brazil. I know it's not an easy country. I'm lucky I'm Brazilian, so I can somehow navigate through that. But yeah, there has been some discussions. Brazil actually officially requested to move to OECD in 2017. I believe the main drivers are commercial ones, because the industry was complaining that local rules basically closed the market a bit. Brazil could not be part of a more integrated international supply chain. So that's why I believe the authorities decided to start this move. Brazilian transfer pricing rules are very unique. They are dated late 90s. The rules background, basically, we need to be simple, we need to be practical, and tax authorities want an easy life and facilitate audit. So it's a formulary approach with fixed margins. So it's a very, very difficult regime to operate if you're part of a more international integrated chain. There is no room for APAs. There is no room for TP adjustments. It's not allowed basically in our treaty network. Recently, I think 2018, Brazil implemented the mutual agreement procedures, but in practice, we not apply that. Particularly for commodities, they introduced the specific methods for commodities in 2012. They said it was inspired in the sixth method, OECD one, but again, with a lot of deviations. The method is the method for the commodities is also linked to international market prices, but you don't show your profitability. What you need to benchmark is your export price in case of exports and your import price. So you need to refer that to international quoted prices. But the way you calculate is only listed commodities are subject to that methodology, number one. So it's not for all commodities. The prices you can use, the quotes, international quoted prices, and the discounts are listed. So it's it's an exhaustive list. You cannot apply any discount you want to reflect your value chain. So there is a complete disregard of any functional analysis. There is a complete disregard for comparability. It's basically a calculation that follows strict rules as per the local rules right now. For instance, if you are exporting, I don't know, iron ore from Brazil to a related party, and you have, huge functionality of outside Brazil that is responsible for marketing, selling, financing, hedging for price variation that has happened a lot. Those costs, those discounts, you cannot apply back to your price when buying from your Brazilian mine. So it's very difficult to operate in an international environment. In terms of managing litigation and controversy, I particularly have not seen any audits or cases with respect to the transfer pricing methods for commodities. Maybe because it's relatively new. The tax authorities in Brazil usually wait for a few years down the road to start, asking questions and assessing. What I have been doing for my transactions is making sure, of course, you do the calculation properly, but that you have a group documentation or documentation that explains what price quote you used and why. Why are you applying this and that discount? If there is a small deviation to whatever, it's there, but you're not applying 100%, have documentation explaining why and supporting that. One component of a discount, for instance, is freight, and you don't export from the same port. So you might have your own port, you never know. So if there is a differential in freight, make sure that that differential is also benchmarked. So you have no questions later on, because whatever adjustments you are doing, you need to use it based on independent parties transactions. So it's very unique in that sense. So if you're paying freight, for instance, to a related party entity, make sure that you have a benchmark for that. And last but not least, this move to OECD. Question mark to me. I know it's important. I know there has been some discussions on that, but realistically, I don't know how it's going to be done, if it's straightforward, if it's going to be a partial one, and when, especially in the context of where we are today. Yeah. Particularly, my opinion, I see a lot of benefits to that migration. I think it will guarantee alignment to international rules. It will indeed make Brazil a country that's more integrated. And I think tax-wise will facilitate a lot our lives in dealing with day-to-day and compliance overall. And also for commodities, I think is a very important move. I think the method as it is today is very unique, and I don't think it helps in any way the Brazilian exporting companies.
So maybe in terms of preparation, it sounds like some basic impact assessment could be helpful, although obviously there's quite some uncertainty if this is really happening, but at least taking stock of, I don't know, was there any historical tax planning? You mentioned, right, your history around CFC, kind of at least what does it look like today? What would it look like under the OECD method? What's the delta? How aligned are the profits and value creation? As you say, likely there's going to be problems in the system given these very rigid rules.
Yeah.
And I think, thanks very much, Cynthia, for really preparing all these presentations and sharing these insights. I've taken away three things so far. Mm-hmm. So the first is, really understanding in depth, I think, the commercial reality behind the trades. Get your business to support you with that. What's the commodity? Why did the deal have to be structured the way it is? The second is we need to be able to bring and explain evidence of that commercial reality in documentation. So there's many ways that we can strengthen our TP documentation, perhaps more qualitative elements, as was said also yesterday, describing that reality, putting a value chain overview, and frankly, depending on your audience, nevertheless thinking how much detail you really want. Time and again, advisors, or at least I'm guilty of that too, we get into a huge, amazing TP technical analysis, and then perhaps we've missed to take a bit of step back, like you said, of explaining simply the value chain and what is actually the commercial reality. Obviously, having some secondary documentation ready is good, as you said, getting the contracts in order. And then the third trend, I think, is have a strategy for managing those differences between OECD and country-specific TP rules. This is always to some extent the case, but with the commodity in particular, where we have the 6 method, the Brazil method, it becomes perhaps even more relevant. And with that, I'd like to thank you again, Cynthia, and everybody for your attention. We hope you've enjoyed this session. I will now hand over to my colleague Massimo, who will guide us through the indirect tax panel and the implications of transfer pricing around goods. As I mentioned, perhaps sometimes not brought up that explicitly on the BEPS. So very much look forward to hearing from you, Massimo.
Thank you very much, Olivia. Good morning to everyone. It is a great pleasure to be here again at UNIL with Vikram and you all. And it is a real pity to make this at distance, and we all hope to meet you soon, as we did in the past after this emergency will be overtaken. Well, I am Massimo Fabio. I am tax partner in KPMG Italy, leading the trade and customs services in my country. I have been talking about the connections between indirect taxations, customs, and transfer pricing since the beginning of this century, I would say. And I had way to discuss this in some papers with the IBFD and also in some manuals I had the way to publish. And it is really interesting now to focus in the links between transfer pricing and indirect taxation. And for this, I would like to introduce the first panelist of this specific session, which is Piet Batiao from the OECD. We have heard from the previous panelists a lot of mentioning of the OECD, so we are anxious to listen to Piet about the connections with tax, with VAT especially. So Piet, please, I leave you the floor, and then we will have the opportunity to listen to Nadia Budenzana after you. Please.
Thanks a lot, Massimo, for your kind introduction. And good morning, everyone. Good afternoon for those of you joining us from other parts of the world. So I'm Piet Batiao, and I'm heading the consumption taxes work at the OECD. Have been doing that for the last 10 years already. Before that, was mainly active as an international tax manager, so not just in indirect taxes in the financial services industry, and started my career basically at the Belgian Ministry of Finance. Quickly, before looking at the VAT or value-added tax specific dimension of transfer pricing, picking up, and you can leave the slide there. I'll just first pick up on some of the points made by the previous speaker. So I'll in just 1 or 2 minutes, I step outside my assigned role, Massimo, to add a couple of points to what was discussed earlier. First of all, in respect to what is happening in developing economies in the transfer pricing space and in the commodity space. We at the OECD, you may know that, are heavily involved, I would say are even leading the tax-related discussions at G20 level concerning the post-COVID-19 world. And certainly domestic resource mobilization and capacity building in developing countries will be a key component of that. So what has been discussed there earlier, I would think you can only expect more of that. Second point on Brazil and the OECD, I cannot not give you a quick update there. I can inform you that certainly at OECD level, we were going full speed ahead in terms of helping Brazil to prepare for accession. I was starting to spend quite some time in Brasilia, helping Brazil to adjust its indirect tax, a very convoluted indirect tax system, to aligning it with the OECD situation or guidance. Things were more or less from our side a bit put on hold because of the outbreak of COVID and lockdowns, etc. But behind the scenes, work is continuing full steam, particularly in the transfer pricing space. So just to pick up on that. Now I'll step back into my assigned role, Massimo, and keep it as brief as possible. So my assigned role is essentially to, without going into any detail, to give you a couple of highlights, a couple of things to think about when thinking about VAT in a transfer pricing context. And I'll talk about two key aspects. One aspect being transfer pricing, the arm's length price concept within the VAT, within the VAT context itself. So transfer pricing as a feature of VAT, sort of in isolation of corporate income tax. And then the second part will be about the VAT consequences, the VAT aspects of transfer pricing adjustments in a corporate income tax context. So on the first part, and that's where we are with the slides at this moment, it's probably fair to say that transfer pricing as such, so concepts as at arm's length pricing, etc., are not particularly relevant, at least not in theory or from a policy perspective, are not particularly relevant in a VAT context. And that's because of sort of the design and the objective of VAT. VAT being a tax on final household consumption. It's a tax on the cup of coffee that Olivia referred to. And it is designed as a tax on consumption expenditure, so focusing on the expenditure, meaning that essentially VAT in principle does not worry about open market values, about at arm's length pricing. It worries about basically the subjective value, the expenditure connected to a transaction. There are obviously exceptions, and a key exception here is obviously the VAT treatment of imports, of goods imports, which very much follows, as you probably know, the customs process and customs procedures. Also from a VAT perspective, VAT is essentially levied on the basis of the customs value plus taxes, including customs themselves and additional expenses such as transportation commissions, etc. As I said, tax authorities, at least from a policy perspective, within the VAT context, do not really worry about open market value, except in specific circumstances. And I'll come back to that in a second. If we go to the next slide, you'll see, or the main message there is that the main reason why VAT policy does not worry about transfer prices is, and certainly not in a B2B context, is again because the main concern is to get the VAT right on the final stage of the value chain. So the cup of coffee or the retail sale of the coffee, and what happens before that in the B2B context is of less concern, because in principle VAT is just a wash through in a B2B context, a wash through, a tax being collected through businesses. So businesses are only involved as tax collectors by remitting the tax, the VAT received on their outputs, and offsetting that with the VAT incurred on their inputs. Other differences with the corporate income tax background is that typically VAT is levied on a transaction basis, which means that value has to be fixed at the time of the transaction and per transaction. So there is no, in principle, there is no aggregation. If we go to the next slide, as I said, concerns about open market values, about transfer pricing as a key component of VAT only occurs in exceptional cases, and essentially those cases are the cases where VAT is not a wash-through, as I indicated. And when is VAT not a wash-through in B2B? That is when parties, when enterprises, businesses are involved that do not have a full right to offset their input VAT against their output VAT, And that's often for the simple reason that there is no output VAT, or because of the fact that the outputs, the activities of the businesses involved are not entirely subject to VAT. And that is typical in a financial services context, for instance, in banking, insurance, etc. Commodity trading may be a bit of a different situation, because commodity trading often, even in a financial services context, will be within the realm, will be within the scope of VAT. Now, we can go quickly to the next slide. I think what are the main concerns, or what could be the main concerns from a transfer pricing concept within that specific environment that I described, that environment where VAT is not a wash-through, because businesses there may not have the right to completely offset the input VAT that they have incurred against their output VAT. They may have an incentive, certainly in a controlled environment, in related companies transaction, to sort of undervalue their inputs, so as to when those inputs are subject to VAT, to reduce the amount of VAT, the amount of input VAT that may not be deductible. Also, from an output perspective, a business that is in a what we call exempt or partly exempt environment, so where their outputs are not entirely subject to VAT, they might have an incentive to undervalue their exempt transactions, so as to increase the relative value of their tax output transactions, and they may further increase the relevance of their taxed output transactions by overvaluing those, so as to increase their own right to input VAT recovery. Now, I won't go into too much detail there, other than to say that these strategies are not unheard of, but they are relatively convoluted. There's a lot of structuring to do, a lot of in-house homework to make sure that everything fits. The risks are often, the rated risks are often significant. The amount of overvaluation, undervaluation will often have to be significant to generate some meaningful impact from a VAT perspective, which leads me to say that, and I've worked in finance for over 15 years, you don't see that much of that happening in practice, because the risks are great, the complexity is great, and the benefits from a VAT perspective may often be limited, and there are often more effective and less risky ways to sort of optimize your input VAT recovery and to optimize your VAT situation. So probably there for me to conclude that within a pure VAT context, transfer pricing and the concept of open market value is not that relevant. If we continue now to the next part, which looks at the importance and the relevance of VAT, or the VAT impact of transfer pricing adjustments, that's a bit of a different story. And in the sense that it has been for a long time, and it still very much remains uncharted territory. And it's to some extent related to what I just pointed out, is that transfer pricing is often not on the radar of VAT policy makers. Either they don't worry about transfer pricing or about the VAT aspects of transfer pricing, or they are aware that there may be VAT aspects, but generally assume that these are not problematic because VAT is supposed to be washed through anyway. Very often also VAT policy makers consider transfer pricing as sort of a mysterious world that they prefer not to get involved in. Sort of don't mention transfer pricing. Which doesn't mean that VAT is never an issue in a transfer pricing context. For the simple reason that indeed you have businesses for which VAT is not a wash-through, but very often also when VAT does intervene in a transfer pricing context at the time of an audit, for instance, then you might be confronted with penalties because you haven't got your VAT right, you haven't adjusted your VAT position to your transfer pricing position. You might be confronted with late payment interests, etc., which may look at turnovers and not at profit margins, etc. So the impact, the financial impact, might be great and typically totally unexpected. So typically, the VAT consequences of transfer pricing will only occur. You'll only know it when you see it, what the impact is. Now, as I said, there is no clear consistency, international consistency in terms of VAT treatment of transfer pricing, and I could probably summarize them in two bits, in two categories. Either nothing happens, where from a VAT perspective, the consensus would be, okay, we're only talking about accounting corporate income tax adjustments that are not relevant from a VAT perspective. If there is any document, any correcting document, credit note, debit note, or whatever, it's irrelevant for VAT because it remains outside the scope of VAT. That's the preferred position, obviously. The other position might be is that the other sort of analysis might be is that indeed, what you need is certainly when transfer pricing adjustments are connected, relate to a specific transaction or sets of transactions, is that you need to adjust your VAT position to the transfer pricing adjustment by issuing corrective invoices with the proper VAT consequences, or even, and that may typically occur when adjustments relate to a set of transactions or to an aggregated position, is that there is something sui generis happening from a VAT perspective that needs to be treated as a sui generis sort of undefined services transactions with VAT connections. Now, as there is no international consistency, we at the OECD and sort of me personally have, because I used to manage transfer pricing in the old days before I joined the OECD, have endeavored to present a number of possible approaches and keeping it really, really very simple, because that's what works best. And you will see those, and I will conclude with that on this slide and the next slide. So what is a possible VAT treatment if one chooses to adjust the VAT position to the transfer pricing position, either at the time of an audit or spontaneously? Now, typically in primary adjustments, when an adjustment relates to a transaction or a set of transactions, you may want to choose to adjust your VAT position by applying the normal VAT treatment to an adjustment to an individual transaction, which might either involve an upward adjustment or a downward adjustment. And in the first case, you just issue an additional or a corrective invoice. In the second case, you issue a credit note with the normal VAT adjustments. Alternatively, and then it already becomes a bit more complicated, at least from a policy perspective, is you consider what happens as a sui generis, a separate taxable supply, in which case you would consider the transaction to be a sui generis supply of services between businesses, a B2B supply of services, again, which you treat for VAT purposes as a normal B2B supply, or as just a financial settlement, a balancing payment that remains outside the scope of VAT. Very often when the adjustment just involves a balancing payment, a financial contribution, in principle, there should be no VAT consequences. Which brings me to my last slide, just confirming that, and that's the next slide and last slide, Massimo, is that the same treatment could apply to spontaneous, so secondary spontaneous adjustments or secondary adjustments, which often involve I'm looking for the right word, a constructive dividend or a constructive capital contribution. in which case VAT consequences shouldn't come in scope as well. Let me conclude there that this has been discussed quite heavily already at OECD level and also to some extent at EU level, with the conclusion that no real consensus has been achieved. And then I circle back to where I started. Very often, because the reason that very often VAT policy officials do not consider that there is a real VAT issue connected to transfer pricing. And when it occurs, that often the view is that it should be treated on a case-by-case basis. I'll stop there, Massimo, and happy to take any questions.
Thank you very much, Piet. And well, I have one question. You just introduced the fact that OECD is analyzing this. Do you think that in the near future we would have some paper issued by OECD concerning this specific topic?
Yeah, probably not. Unfortunately not, I would say. We have tabled, I myself have tabled the issue a couple of times already for discussion at OECD level, and it has been discussed at a number of rounds. I tried to launch that discussion notably in the context of the BEPS work, anticipating that the number of transfer pricing discussions, adjustments, etc., would increase, and that with that also the number of VAT disputes might increase. Certainly when developing economies are involved, because very often in developing economies, the concept of VAT as being a tax on final household consumption and not a tax on businesses has not sunk in entirely. We're doing quite a bit of work there in that context. I'm doing quite a bit of capacity building myself, but the reality still is that VAT on business-to-business transactions is still seen as an important revenue source in many developing economies. So from that perspective, we have tried at OECD level to stimulate discussion in that context, which is happening, but which for the moment has not been reflected in drafting in a paper that certainly not that could be released, for the simple reason that as OECD we are a consensus-based organization, so we can only release stuff, guidance that is consensus-based, and for the moment there is no consensus.
Very good.
But certainly
thank you.
There is awareness of the issue, and we're working with countries to address it where appropriate.
Thank you very much, Piet. And so I'm glad now to give the floor, the video, I would say, to Nadia Buzenzana, which is the Senior Director in Global Trade Compliance in Honeywell. And I would leave Nadia to introduce another topic which is hot in the indirect taxation, which is referred to how reconcile custom valuation and transfer pricing. Nadia, please, the floor is yours.
Thanks, Massimo. Thanks for the nice introduction. Hello, everybody. Good morning and good afternoon. As Massimo said, my name is Nadia Buzenzana. I'm based in Switzerland. I cover global trade for more than plus 15 years, as Massimo mentioned. Customs valuation and transfer pricing is a hot topic and is just a passionate topic as well. There is a lot of improvements to do in the future, but today I'm glad to be here. I want to share some positive cases. And yes, it is complicated. Yes, there is not a total conversion. And yes, you need, the customs people and the indirect tax people need to go a little bit more into the transfer pricing knowledge. This is what I did a few years ago with the UNIL. And thanks to Vikram and his team, which helped a lot, in fact, in understanding, although being in a multinational and several multinational in different industries, you see similarities, but it's very good to go in depth into the regulations and the requirements and be talking in terms of legal framework and legal requirements with the customs authorities. I saw that it was very positive in a number of cases, and I would like to share some of it today with you, whether in Asia, whether in Americas, whether in Europe. Please use the chat for questions. Today, I'd like to take the opportunity to talk about a very simple case. There is a lot of participants. I'd like to keep it simple. but please raise the hands for any other events to say whether you need much more complicated cases or if there are some other supply chain and flow of goods that you would like to see. I recently saw a very nice questions around first sale, Massimo, that we probably need to talk about in transfer pricing and in customs valuation. That is
exactly.
That is a very technical answer. This is saving a lot of dollars, millions of dollars for a lot of multinationals. So it will be very interesting to have a look at it. So let's have a look at a low risk distributor. And option one is with a principal in Switzerland that sells to a distributor in the US jurisdiction. And we've got a 3% operating margin at the low risk distributor level in the US. The Swiss principal will issue TP adjustments at the year end to actually meet that 3%. So what it means in terms of customs, this is underneath on the left-hand side. You will, and if you use the transfer price, in that case, I haven't mentioned it, but it's a resale minus price, you would have to, obviously importing the goods to US, declare a customs value. You have two choices. In the US, you have the ability to either use the transfer price or use a completely reconstructed value if you do not meet the customs rule into the US. In my case, we are using the transfer price. And I would like to point out a few number of, let's say, important information while we use transfer pricing as a customs valuation. So first, going back to a little bit of rules that Massimo is going to cover a little bit later, so I'm going to be very brief. You need to be looking at the circumstances of sales of the transfer price, meaning that you obviously need to substantiate that the price was not influenced by the relationship between Switzerland and US. And there is plenty of documentation in transfer pricing to do this. And we will see how all of this is critical. So you import the goods with the low risk distributor in the US. You will declare the transfer price. When the Swiss principal will issue the debit note, at that time, this will be the time to actually go for a customs valuation adjustment. However, two important things. First, you have to declare that the value is to be reconciled at the end of the period, which means it's a temporary. Second, you need to choose whether you want to go for a transaction value or any other things. There are some jurisdictions as well, it is very interesting to point out, will ask you whether the price is actually between related party or not. And that you will have to also mention. And I'm sure everybody heard about the Amamatsu case. That was the issue in terms of not importing, declaring the transfer price as a definitive value, whereas it was subject to adjustment at the end of the period. So super important to actually make sure that you declare to customs that it's subject to adjustment at the end of the period. So US particularity here is that they have what we call the US Customs Valuation Reconciliation Program. You flag your customs entry. So your customs entry is your import declaration and say, I'm going to reconcile at the end of the period. Then you do what Massimo is also going to cover later on, a weighted average spread of this value, this debit note into the entire number of entries that you've declared into the US using, like we do in accounting, a fixed cost key type of calculation. There is a lot of customs brokers that do that very well in the US, and that is a very widely used program into the US. What is interesting into the US, and that's why I like this example, is that there is a convergence in terms of ruling, in terms of regulation between the customs authorities and the tax authorities. So they've been working together in picking up legal requirements on each side and converging it into what an importer should do in the country. And this is what I talk about in a few other points below into the slide, is that a lot of US CBP Customs Border Protection rulings are actually pointing out the importance of transfer pricing for the acceptability for using the transfer price as an imported value. For example, you need to have TP studies that is going to show and substantiate the profit margin of the low-risk distributor. So you would think, in terms of customs valuation, I only need to take care of my transaction value, computed value, my method, what I need to add. Obviously, in that example, I haven't complicated it with royalties and things like that. But this way of doing this has changed into the customs authorities and the industry. Right now, I've been very surprised to see customs authorities being super, let's say, informed, knowledgeable in tax law and in transfer pricing. Recently in Asia, I had several questions on the profit margin of the importing entity. Before, you would have questions on the importing value. Now there is a global questions of, can you explain what's the risk, functions, and assets of this entity that justifies the transfer pricing that you're currently using and the profit margin of your entity that's importing the goods. And for example, if your profit would be too high, there would be a big concern for customs administration that you're actually undervaluing the goods. So it's very important to actually work with tax and look after this whole transfer pricing setup for your importing entity. So going back to the rulings, if you want to use the transfer price and to make it accepted by customs, you should have a TP study showing the profit margin benchmark of the low risk distributor, an economic analysis. That is going back to the circumstances of sale. That means the price has been set up as if the two entities were unrelated. And obviously that needs to be within the normal pricing practices of the industry. Going back to Cynthia's comment, important is, yes, you need to know your industry, the market, the prices. And also somebody in the chat was mentioning that sometimes the tax authorities would take the higher level. Yes, and they would compare your entity with the wrong entity as well. And they would compare profit on two companies that have no, let's say, common themes. So you need to be, let's say, knowledgeable about your profit level, about the prices, about the market. And all of that is completely new for some of the customs experts, right? It's been developing for the last few years. So this is what I would really strongly suggest for my customs counterparts around the world. The other CBP ruling that points out on adjustments is also very interesting because it sends you back to IRS sections actually. And that's where I was talking about convergence between tax and customs. So you can use TP studies, TP documentation to actually make your customs valuation accepted by the customs authority. So you need to have obviously a TP policy. And the TP policy needs to talk about how you set up your price, what's the method, and that you will be doing adjustments. And those adjustments obviously will have to have a transparencies on accounting details. Obviously, the best in class would be that you, let's say there are solutions, but you do less of year-end adjustments, a little bit of transfer pricing fluctuations to avoid a year-end adjustments. It is very complicated to do that in industry. So we will leave it at doing a transfer pricing adjustment at the year-end. To finish on the sharing of the examples, I just wanted to share with you what are the best practices and recommendations, either for my customs counterparts around the world, but also for the administration. The indirect tax team, including the global trade, the customs, the VAT team, to have a seat at the transfer pricing and direct tax label. Very often I hear tax people saying, I do not see any link with the customs, or customs do not really understand what's going on the transfer pricing side. And I would strongly suggest that those two are actually talking to each other on a regular basis. You can go to the next slide, Massimo. This is actually what needs to be done. You review all the intercompany agreements. There is a review whether there are royalties, whether there are other intercompany payments that needs to be considered for the addition to the customs value. Obviously, if there will be TP adjustments, what kind of TP method we're going to use. I saw as well many customs administration for TP variation over 10% asking justification, what is making your TP fluctuating that much? So you need to be ready with variation. It can be cost related. Sometimes in the accounting world, we're using averages of cost, and then you've got your cost fluctuating depending if it is commodity or not. So those have to be monitored and actually aligned with the tax team. The other thing that Cynthia said, which is very good, is you absolutely need to align your speech when you talk to the authorities with tax. There are tax policies that needs to be followed. You need to obviously consult the headquarter, and also Olivia mentioned about the value chain. I found it a very powerful tool to actually, when the customs authorities take it from the profit level of the importing entity, the value chain gives a broader view of how the intercompany operate and where the value is created, where the risks are, where the assets are, which justify the category of the entity, whether a low-risk distributor or a contract manufacturing. TP documentation, again, very important. TP policy, TP studies, the economic analysis on your function assets and risk analysis that are going to support your customs circumstances of sale, your test value, your industry specific benchmarks, and obviously help you through the TP adjustments if this is all explained into the TP policy. A yearly assessment is what I've done in many of my previous experience with the tax team, and obviously being involved in APA, because in some countries APA can actually be used for a customs value validation with the customs valuation branch, and completely accepted in front by the customs authorities. On the right-hand side, this is what I would wish and would recommend from tax and customs to work on, is that for one TP method, we would have a customs valuation acceptability and a clear understanding for importers and industry around the world as to what is going to make a transfer pricing acceptable from a customs perspective. To me, a cup, whenever you would have identical goods or similar goods and you can prove it, the TP should be accepted. When you have a cost plus method as a TP method, and you can show that you recover all your cost plus a profit with reasonable profit, and you have documents, TP documentation to support that from the exporter that is substantiating the exporter markup, I would love to be this completely accepted by the customs authorities. Resale minus is the same. We have a similar method, which is called deductive value. But whenever I have the agreed margin, comparables completely substantiated, and the functions and assets from the exporter, I'd like to have this accepted by the customs authorities, and same for TNMM. And we can see that is absolutely feasible. There are solutions. Sometimes a bit more difficult, a bit more complicated, but US is a very nice example. It's working well, and the companies can do safely their adjustments and with a complete conversion between the tax administration and the customs authorities. With that, I think I'll hand it over to you, Massimo. Thank you.
Thank you very much, Nadia. And let me ask you if within these different documents that should be helpful in order to reconcile a transfer price adjustment in customs value, do you see the opportunity to integrate the transfer price documentation with a specific paragraph concerning the customs methods to be applied?
Yeah, that's a very good question. Actually, very often we say that arm's length cannot be linked to the requirement on the customs valuation where we say the price is, you need to substantiate the price is not influenced by the relationship. Well, I want to have a complete one-to-one relationship and complete convergence between the two, because to me, whenever you have transfer pricing documentation, that proves arm's length and you can substantiate that, this should be enough for customs valuation and customs authorities to substantiate that the price was not influenced by the relationship, because this is exactly what we're substantiating under arm's length. Then on the circumstances of sales, it would be also very good to have very specific TP documentation that can be used for circumstances of sales. And I go back to the intercompany agreements. This is a contract, and this is substantiating that there is an agreement between two related parties, but actually we are behaving as if it were two unrelated. We've got a contract, we've got conditions, we've got terms that are completely agreed and signed, and this is very much detailed. So this, I'd like to see those type of things nailed out and completely detailed into the customs value. And I think US is a good example from where we can take it off. But I've seen in Korea, in China, a very nice evolution. India as well have a complete separate process, but I see nice evolution in those countries as well.
Nadia, thank you very much for your interesting speech and analysis. And I would go further in conclusion, taking the time we have lasting, which is approximately 10 minutes. Let me tell you all that one of the questions who's raising is that any opportunity to solve the issue when you have a downward transfer pricing adjustment? Well, this I think is the key point of this entire area. Because if you have, before any custom office, the need to increase your value, the custom office within the world would be very glad to accept any amendments of the entry declaration in order to tax the further amount with the tax rate applicable in that country. While if you have a reduction of the value, this is something that should be discussed, because in the background of the customs authority, there is not the way to allow any economic operator to get a refund of the duties which were paid on the declared value, which was then decreased by the application of the transfer pricing policy. Well, of course, this has to be also faced with the difficulties that we may have in many countries where we have two different administrations, one ruling for revenue and another one for customs. This is, for example, the case in my country where we have two separate entities with a different approach and different background. Well, until 2010, any customs authority was reluctant to accept any transfer price adjustment in customs valuation. And finally, you see, just in November 2010, we had the contribution from the WCO, which is the highest customs body in the world, who finally stated that the circumstances surrounding the sale are interesting also in relation to the use of transfer pricing studies. So only after 2010, November 2010, we found across the global market some customs authorities which would more keen to accept some transfer pricing discussions. Well, we had another interesting support in the global debate concerning customs and transfer pricing given by the ICC, the International Chamber of Commerce, with its policy statement, which was delivered in 2012 and then updated in 2015. As we will see in these few minutes, the ICC gave some suggestions, mainly to the Customs Office, in order to ease the reconciliation of the values between transfer price adjustment and customs entry, in order to support the business to solve these dramatic issues sometime. And finally, we got from the WCO an extensive guide, which was delivered in 2015 and then delivered in a second edition in 2018. This is an invitation to all customs authorities in the world to take into account the transfer pricing adjustment and then be consequent in order to both apply the duties on the increase of the declared value in case the transfer price adjustment is upward, but also allow the refund in case this adjustment would decrease the customs value. Well, the ICC policy statement was groundbreaking, as I was saying, because finally gave specific instructions to solve a big issue that we face when we want to apply transfer pricing adjustment in custom valuation. The main issue is given that if you want to report the transfer price adjustment related to some entries in one country, the traditional customs approach is based to entry by entry amendment. So any business should be obliged to go back to any entries filed in the last year eventually, and then apply for any single entry the adjustment which is given by the transfer pricing policy. This is burdensome. It is very sometimes inapplicable. I had a case of a big automotive multinational company who made in 1 year, in one fiscal year, 130,000 customs entries. So the point was, if we would allow this company to amend all the 130,000 entries, this would take busy the entire customs agency for 1 year and more. So what is the perspective given by the ICC? First of all is to invite the customs officers to recognize the post-transaction transfer pricing adjustment. And this should be made for both, for voluntary compensating adjustment or whatever is coming from a result of a tax audit. So this is a big step in order to make clarity in how treat the transfer pricing adjustment in customs evaluation. But this proposal, number 3, is another groundbreaking suggestion given to the customs authority. I was saying that the approach of the customs is to go entry by entry. Well, this perspective given by the ICC is to take the entire value linked to the imported goods. So let's take one tax year, one fiscal year. We have imported in one country 50 million of goods. Well, the delta given by the transfer pricing policy is 5 million more or 5 million less. Well, let's make one single note, which the increasing amount without referring to all the different entries, and let's apply a weighted average customs duty rate. This is needed because if you are importing a lot of different commodities, even if you agree to apply the higher duties to the delta to all the entries, you should find out any single duty rate applicable to the different stuff. Well, the suggestion to apply the weighted average customs duty rate solve these issues in 1 second. So by approaching the authority with this kind of solution, any business would be allowed to finalize the reconciliation with one note, one customs duty rate, and with one single amount related to the all entries made in one fiscal year. This is really interesting. And of course, any business, if would be involved in some post-transaction transfer price adjustment, should be relieved to submit, as I was saying, an amended declaration for each initial customs declaration, and of course should be relieved from the payment of any penalties. Transfer pricing is affecting more than the 60% of the international transactions now, and so customs authority should apply these suggestions given by the ICC. I would like to show you also another point that we have shared with Nadia earlier, the point that the transfer price documentation should include a paragraph describing what is the approach in order to let the customs administration, which will be the method that the business would use in order to reconcile transfer price adjustment with customs value. Well, all these should be, of course, match with what the WCO underlined. The good news is that while ICC is not binding in its suggestion, the WCO is the highest body for customs authority. And so this body, in its guide on transfer pricing, updated in the last version in 2018, gives a specific invitation to the customs officers to comply with this new approach. However, it is said, the WCO, when he said that the customs treatment of transfer price adjustments, it is inconsistent around the world. So this is the background from which WCO starts its guide. It says, guys, you are not complying with a modern approach, so be aware that you should, all custom office of the member countries of the WCO, comply with the suggestions given by the ICC and supported by the WCO. This is the point. Since the Kyoto Revised Convention accept the fact that repayment of duties and taxes which were unduly paid should be given back to the enterprises, well, matching these customs principles with the suggestions given by the ICC and the approval of the WCO, this should be the way to get the transfer pricing accepted in customs reconciliation. So the guide states that, you see, this should be the roadmap to be covered. A transfer pricing policy should be in place prior to the importation or the clearance of the good concerned. So it is needed that any business has a signed transfer policy with a date which is put in place earlier than the transactions that will be subject to transfer pricing adjustment. Then there is a report, there is a sharing approach with the customs authority. Customs authority need to know at the beginning, in day one of year one, that the TP policy will be applied also for customs relevance. And this is what happened in the Hamamatsu case that Nadia mentioned. It is a decision of the European Court of Justice that we will see in a few minutes, in which a company applied to ask a refund since they introduced some transfer price adjustment, decreasing the value of the entries. Well, the authority denied to give them the refund because it was stated even by the ECJ that the customs did not know that such transactions would have been impacted by a transfer pricing policy. So it is crucial that customs is informed that you are applying a transfer pricing policy, and with customs there should be an agreement in order to identify how to solve this reconciliation. So this is really mandatory, and this is the Court of Justice I was saying. I would like to bring the attention to the second indent. You see, it is stated that it being possible to know at the end of the accounting period whether that adjustment would be made up or down. So there was unknown the final use of this transfer pricing by using the profit split method. And so that was the ground for the court to refuse the transfer pricing adjustment. I would not go through the VAT implication because Piet already gave you all the scenario. Just to remember you that there is a working paper in EU which is not binding but recommend to treat the transfer price adjustment under a VAT perspective, hopefully qualifying as an outside of the scope of VAT any adjustment. But what I would finally tell to you is that we need, in order to reconcile, to be allowed to reconcile the transfer pricing at any custom office of in the world, wherever is the transaction, the intercompany agreement signed, clearly signed earlier than the first customs operation, we need to have a policy which is again signed between the parties. And also it is very well advisable to approach the customs authority, even formally, by placing a customs ruling. So this is the way to have a clear share of what will be the actions, and hopefully ask to the authority, to the customs authority, to be allowed to use the solutions provided by the ICC and supported by the WCO, which is binding in its statement. And so we should remark with any customs office that we are entitled to simplify the transfer pricing reconciliation, just because also the WCO gave these instructions. So I guess we conclude within the time almost, and I would really like to thank all the panelists for this indirect tax session. And I am now giving the floor to Vikram, thanking Vikram to all the support gave us, UNIL, and in the perspective to be able to meet you again all in proximity, in a presence next time.
Thank you, Massimo, for that. And thank you to all the panelists. Actually, we still have, we can go a bit for 5 minutes. So I suggest we take a few questions from the floor and or some other comments from Pete or Nadia with respect to your presentation. Maybe Pete, you would have some kind of inputs. You know, you already gave a very nice overview of the tension between VAT and TP. But what's happening at the level of the OECD with respect to TP and VAT, TP and customs, and maybe you would just like to remark on Fabio's presentation.
Yes, thanks, thanks, Vikram. First of all, I found the session here today quite interesting and fascinating, and a lot of touching upon ongoing OECD work on several in several aspects, as I indicated, the aspect of sort of an enlargement, as we call it, with Brazil, and also the aspect of and I would stress the importance again of the work in the context of domestic resource mobilization for developing economies. Developing economies, and obviously it's a diverse situation, but many developing economies have been hit quite hard by the sort of economic consequences of COVID-19, and specifically the impact that COVID-19 has had on international trade. And many developing countries have seen trade in raw materials, commodities fall significantly. And so from a policy, from a political perspective, there's quite a bit of attention going, notably at G20 discussions, going to efforts to support developing countries in addressing the challenges that arise from the economic challenges that arise in a post-COVID context. So there will be a lot of attention going to initiatives such as tax inspectors without borders that will notably assist, for instance, transfer pricing audits and discussions at the level of developing economies. Just to confirm what many of the other panelists indicated in terms of knowledgeability of tax authorities in developing economies, including customs authorities. When it comes to the interaction with customs, you probably know that we work very closely with the World Customs Organization in a range of areas, historically for a long time already in the transfer pricing space, but increasingly also in the VAT context, specifically, again, in the context of growing international trade, but also disruption of international trade in a post-COVID-19 context, very much in a context also in a context of digital trade, where we are looking at increasing the interaction and sort of the consistency between customs and VAT treatment. So that's another aspect that keeps me personally busy very much. And just to conclude, Perhaps to pick up on the point that Massimo made and the reference to the VAT expert group's document released by the EU. It's a very nice, well, there are two documents. There's a document from the Commission itself and then a reaction, I would say, from the VAT expert group. There are very nice documents and I would really recommend you to have a close look at them, in the sense that they take a bit more time than I have taken in setting out the policy and theoretical background of the interaction between VAT and transfer pricing, but essentially come to exactly the same conclusion, that tax authorities would generally agree that they're not that worried about the interaction between VAT and transfer pricing, but not wanting to take a consensus and definite conclusion or position, wanting to keep their hands free to be able to address issues on a case-to-case basis. And that's still very much the case also on a global level, at OECD level. We are having discussions among tax authorities to address specifics. We are trying to drive countries towards a consensus position, but it's difficult for the moment. There is no widespread policy consensus amongst countries to sort of, for a consistent and consensus position to be seen to be published, because that would tie their hands in a case-to-case context. I'll stop there, Vikram. Thanks.
I think we have a few minutes more to one more question, Vikram, if you agree. And I would ask Nadia, I would submit Nadia one of the questions, which is, could unilateral or multilateral APA with tax authorities have an impact also for customs authorities in order to have a common path, so for one-side TP methods? What do you think, Nadia?
It's a very good question. Thanks, Massimo. Yes, because obviously intercompany and multinationals would be working on international flows with a TP exporters, and then the entity that's receiving the goods would be using that TP as the customs value for importation and therefore payment of duties and VAT and other taxes. So multilateral APAs would be just great for the industry, because we've been many times in cases where either the exporting country or the importing country would not be in agreement. And then again, the industry is in the middle, trying to satisfy the tax administration and trying to satisfy the customs administration. So the answer is yes, with an APA multilateral that is actually accepted by customs, meaning that it would be accepted from a customs administration perspective and from a tax administration perspective, because you can have APA that are only going to be utilized for tax purposes, and some countries would actually refuse it for customs valuation even. So it's very important to have both together. And in terms of the dilemma close to that is, for the importing entity, the higher profit it is, the better it is for the tax authorities. It is usually the opposite for customs. If you have a high profit into the entity that's importing, the customs is going to challenge you that your price was influenced by the relationship and therefore it was undervalued. And therefore, this multilateral APA is going to avoid those kind of situations. Thanks.
Thank you very much, Nadia. I guess we are within the time. Vikram, just let me know if we can go.
I think we have to stop now.
Okay.
I think this conversation can go for the whole day then.
Thank you very much then to you all. Thank you very much.
Yeah, thank you for this wonderful session. I would like to thank all the speakers once again, Fabio and Olivia for leading the sessions, and Pete, Nadia, and Cynthia for their wonderful interventions. Thank you all for your participation.